G'day, Vern.
G'day, Woody. How are you?
Good, good. Not too bad. Weather's getting a bit better over here, so it's not quite as good as Queensland. So
No, that's okay, mate. It'll warm up soon enough for you. You can get rid of that jumper.
yeah, yeah. Well, this is my signature jumper. I always wear a black jumper when I come on screen.
Like Steve Jobs.
Yeah, exactly. Although, yeah, just less brain power. So, Vern, you've just this week published a really pretty important report, which has been a long time in the making. So I thought it'd be really good to get you on camera to have a bit of a chat about it, because you make some quite big assertions in that report. Yes. Now it's a pretty important message as well, because anyone that you say is being lost, that anyone listening to the mainstream narrative right now is being, people aren't talking about this thing. And you call it the everything bubble. And now your report is called the Everything Bubble Cash Out Strategy and how to smartly exit code red investments now. So it does have a pretty controversial title. So I thought we could just dig into some of the ideas that you write about in that report. So, but first I'd like to just get a bit of context around the whole thing. So, so essentially you're saying consider dialing back on these four key investments or markets and to cash out. The trouble is that people look at what the central banks are doing. They're flooding the money, the world with cash right now. Interest rates are at near zero. To the man on the streets, the man or woman on the street, it looks like there's no choice but to be in the market, because it feels like the purchasing power of your cash is going to get eroded pretty certainly over time. Can you explain the context? I guess it's this inflation discussion. What are people meant to do?
Yeah, I know what they're meant to do, but doing it is difficult, because at any given time, you talked about all this extra cash that's been put out into the system, but at any given time that sits in a bank as well. So if you've got $100 worth of BHP shares and I got $100 worth of cash, we exchange things. That cash is still going back into the bank account. So at present, there's a game of hot potato going on, because people are of that mindset that, hey, central banks are destined to take these asset prices ever higher. They'll never let them fall. So there's this, I've got to get out of cash and get into these asset classes, whatever they be, crypto, property, shares, bonds. And someone who's selling that will say, well, I'm happy to I'll take that cash now because I've got in at X and I'm getting out at Y. So there's always this moving game going on at present. And interest rates have certainly played a part, because people say I'm getting nothing in the bank. So while this game of ever increasing asset prices is going on, the capital growth side of things, people are saying, well, that's far more attractive to me than being in the bank. So, and the only reason they're doing that is because they perceive there to be no risk. There's this safety net, there's this proviso from the Fed that they will just catch them as they fall. So the Fed is sort of has provided this de facto guarantee, but it's really been the social mood of people that collectively have said, hey, these other assets are the game in town that we should be in. So there's been this speculative fervor that's been out there that's making prices rise. It's not the Fed making prices rise. It's the fact that they've just given people the belief to go out there and chance their arm that is doing it. But if that social mood changes, if the horse doesn't want to drink from the Fed's well anymore, and it decides, no, I'm not going to participate in this in sufficient numbers, then that momentum wanes. And we haven't seen, since 2008, we haven't seen that sort of collective fear take place, that concern. And bear in mind, the Fed was dropping interest rates and printing money, doing QE back then. They were trying to support it. And the only thing that arrested the fall back in 08, 09, and people are not aware of this, is the Fed changed the mark-to-market rule for banks. of their assets. And so once they didn't have to mark to market anymore, that that the holdings were this level, and they said, oh, this is on a long-term valuation basis, they're this. That's what stopped the rot. So there was still this concern, and we saw an element of fear in March last year too, Woody. With the when the coronavirus first hit, and there was all this uncertainty. So you can see how quickly the mood can change if people are concerned about market values. They will sell into a market. Again, the Fed arrested that with an unprecedented level of stimulus. But has that firepower now? That sparked it. We had the meme stocks. We've had a speculative fervor. But what we're starting to see, and probably the biggest meme stock out there, was ARK, or not speculative stock. But that's coming off as well. So has that also run its course? And if we do have another hiccup in markets, can the Fed arrest it? Everyone believes that that's possible, but if you look at the collective firepower they've had to use every single time, it becomes more intense and greater in volume. And, I'm just wondering, I just question, I don't have that unshakable belief that the Fed can be more powerful than millions of people who have decided, my retirement future is hanging in the balance here. I'm not so certain about this. And don't forget, we're now 11 years older than we were, 11 or 12. So if you're an investor in your 50s in the GFC, you're now getting closer to that retirement. So, and the All Ordinaries took something like till 2017 or 18. It took another, the best part of 10 years to recover where it was all from its all-time high in 2007.
Well, let's talk about that a brief moment from a longer-term perspective. So you wrote today in the Rum Rebellion, you did show, we were talking about this just before we hit record, you showed a pretty compelling chart which looked at the reversion to the mean of, I think it was like the net worth.
Net worth to household disposable household income, yes.
Well, you can see the chart on the screen. Can you see that, Vern, all right?
Yeah, this is the other one that actually shows the average, the long-term average, if we go back.
So this
then
gives
we
us
get down the other one. So that's this one there. Yeah. Well, that goes back to, this is the Federal Reserve's own data. So this is not some sort of institutional or Vern Gowdie made up thing. This is from the Fed's own data. And it goes back to 1950. So we have a sort of 70-year pattern here, post-war pattern of what happens. And the simple logic of this is that, based on a disposable income, like into the Woody household, there's a multiple of that income that you can have as your net worth. So if you've got an average of $100,000 coming in disposable income, historically it's been about 5.5 times that has been the net worth. Obviously for some other people it's more, for others it's less, but that's been the historical average there, and which makes sense. You can only gear up so much, even only do so much with your income. So if you go back to that post-war period, that was when America was up on that previous chart. I'll walk through this other chart.
Sorry, yeah.
That post-war period, that was the period that Trump referred to as "let's make Australia great again." That's when there was a collective sharing between capital and income. Workers and industry both prospered, and things moved up in a genuine fashion. Well, the ratio there was around about that 550%. It was a fairly steady equation back then, income to net worth. Then, and again, most people don't realize this, it's what they call a secular bear market. The US share market, after peaking after this sort of post-war boom in 1965, went for 18 years, and the Dow stayed around 1,000 points for 18 years, up and down through the inflationary 70s. So what happened was net worth shrank as a multiple of income, because incomes were rising, inflation was going up, but share markets weren't going anywhere; they were going down. So net worth actually shrank from there. So it went below the average. Then came the revival in the 1990s of the US share market, and things got off to a good start. And they moved back, sort of magnetically drawn back to this 550, 560 zone until the late 90s, which we know, mid to late 90s, which we know was in the dot-com boom. So again, because of that euphoric mood that existed at that time, net worth got lifted again because the share values were higher, and that created the dot-com bubble. Bubble burst, bang. Where do we come back to? The 560 line, you know. It's just then boom, Greenspan drops interest rates. They're very accommodated with lending, and we have this housing bubble. So everyone's housing values are up, share markets are up. So collectively, household net worth rises as a percentage of income. Boom. Then we have a corrective event, the GFC, which then brings in, bang, takes us back to that 560 level again, 550, 560. It's like that's the average, that's the balance where we should be. Things settle around there because, you know, for a little while, then off we go again, you know, more QE, interest rates are lower, and then we take off. And this is just, again, you can see that trend line that I've drawn there between connecting the bubbles. It's just one bubble expanding after another bubble, expanding even further after another bubble because of the Fed's activity in promoting these asset price inflation. And it just gives you an idea of the extent they've gone to in order to create this illusion, because underneath that, the economy is basically weak. GDP growth in the US has been less than 2%, you know, well below its long-term average, which was 4% prior to 2000. So economic activity is not there, but the Fed has had to create this wealth effect, so to try and stimulate spending. So if we look at that, I then go to the next chart, and you look at the corrective processes that in the event, so you can see there that, you know, there's the blue line trends along, and then I've continued the arrow as the 70-year trend. So when the dot-com bubble corrected, it only corrected from a small level, the net worth. So net worth sort of flatlined for that period. Then came the US housing bubble, and you could see it rise off the trend, but again, it fell down back to trend. And that fall at that time was about, in dollar terms, was about $11 trillion. US net worth went from 70 to 59. Now, that at the time was about 80% of US GDP. US GDP at the time was about 14 trillion. That gave us, as Obama said, the greatest economic crisis since the Great Depression. So that was $11 trillion worth of notional value that was just vaporized. You know, it was not real. It was just created because of the conditions at that time, the euphoric market conditions, the accommodative policies of the Fed, and everyone got in on it. And then the speculative fervor died. You know, the panic set in, markets collapsed, because there's always excesses when there's a free-for-all. Then it's taken off again. And you can see now that it's just gone to a level, it's now saying $140 trillion worth of household net worth. Well, based on the 560, 550, 560% range trend, the net worth should really only be about 96 trillion. There's been $44 trillion of excessive value created in all asset classes, because we've now got cryptos that they weren't there pre the GFC. So you got the cryptos, you got the property, the US property market's back again. Share markets we know are trading at all-time highs, and you got the bond markets, which have been pushed up higher because of suppressed interest rates suppression. So you've got this value, this value in theory that's been created, or it's been created on paper, but it's not real. It's all unless, of course, there's no reversion to the mean doesn't happen. Unless, of course, the Fed can magically build a prop, which it's never been able to do previously, that keeps this up there. But even if they do, you then got to say, well, okay, now that you've got it up there, how do you keep it there? Even if it just flatlines, then asset prices will not go anywhere, or you've got to increase wages to reduce that house disposable income's got to be reduced in order to change that ratio. You know what I mean? So if you've got 10 grand's worth of disposable income, and the ratio is 8 to 1, you've got 80 grand's worth of assets. So if you can get disposable income up to 20 times to 20, then you've got a 4 times. But disposable income is going to be hard to come by because you've got these inflationary pressures with oil, with energy and food coming through. So that's going to be difficult to manufacture. Even if you do have wage growth, what's left in disposable terms is not going to, I can't see, will only move at the margin because you've got these higher costs coming into household budgets. So unless reversion to the mean no longer applies, or the Fed can somehow build a permanently high plateau there, which is a dangerous concept, as Irving Fisher found out.
I was going to say in 1929?
3rd of September 1929, Yale professor, he said, now we've reached a permanently high plateau. Well, he was, anyway.
But that suggests you've got another 9 years to go, right?
No, that was 1929.
Yeah, I know what it's. Sorry, yes, another 8 years to go.
No. No, we're already at our high plateau, mate. We ain't got. So how far above trend can they continue to push these values? And every dollar they push it above there, if based on the historical precedent and the concept of, the mathematical concept of reversion to the mean, then all those dollars are just illusionary anyway, because they're destined to come back to a more balanced or reasonable level, which is what the trend has been for 70 years. So I think what we're in is this, and what I said back then, that was 80% of GDP in 2008, 2009. $44 trillion is 200% of US GDP. That is just mind-blowing. 80% gave us the greatest economic crisis since the Depression. What's 200% going to do? You summed it up.
You summed it up with I know the term "the everything bubble" is a pretty well-known concept now, but you look at the dot-com boom and you can point to the dot-com stocks, and then you look at the property market and subprime. But this is a bubble in everything, you say.
It is because of the accommodative policies, yes.
Yeah. But you've highlighted 4 key markets that you should be really wary of. And maybe it's a way to navigate the whole thing, because when you say everything bubble, it's conceptually almost an abstract idea. So perhaps we can break it down by the 4 sectors that you say that are concerning you the most, or perhaps they're the sectors that you see they're the ones that are
red hot, and it radiates out from there, because it's like the dot-com area was hot in 2000, the tech stocks, but that didn't stop blue chips getting hurt, because where there's a lot of debt or margin debt that's been used to pile into markets, people can't sell out of illiquid investments when there's a run on, so they then have to sell their liquid stuff, the quality stuff. And to get out. So but these are the ones that are going crimson red, that are flashing in my mind.
Let's start with tech stocks then. Can you just talk us through specifically why is that distorting things at the moment, or why is tech stocks your number one code red, or at least the first one that's flashing at the moment?
Well, they just attracted so much inflows, be it through algorithmic trading, with index funds, or people saying, yes, the tech is the future. And you've got to the stage now, like the S&P 500 is so named because there's 500 shares in that index, 500 companies in that index. Well, in theory, if you're doing it on an equal weighted basis, there'll be 0.2% per share weighted towards that index. Well, in fact, you got the handful of tech stocks, the FANGs, half a dozen of them that are something like 25% of that index, and the other 494 make up the other 3/4. They are just been so dominant. Had such cast a huge shadow, and so their thumbprint on the scale of that index has been enormous. Has put a lot of weight on there. And again, I saw this in the dot-com boom, and I haven't got the exact data in here in front of me. But people don't realise that when the dot-com boom bust, Microsoft fell something like 80% in value. the big blue chip names of that time who are still here, like the Apples and that, they got absolutely hammered in the .com because they become such a dominant part of the market. They attracted so much investor attention that their prices were pushed up significantly beyond their fair value. And it was just a momentum thing. And it's played out, Woody, this is played out. I can go back to the railway stocks in the 1800s, the banking stocks in the early 1900s, the automobile stocks in the late 20s, the Nifty 50, they call them, the household and type of stocks there, that were coming through when the US consumer boom was on in the 60s and 70s. And there's a sector of the market that just becomes white hot because people, they preface their statement with, you cannot go wrong buying, so you cannot go wrong buying Apple. You cannot go wrong buying Westinghouse if you're in the 1970s, the white goods maker. And that is a fatal mistake because once you discount risk out of the equation, that's when things are their most riskiest.
Do you think, devil's advocate question, just because I'm sure it's on a lot of people's mind, when markets are raging and there's a strong statement that comes out that you've made this week, there's questions, obviously, and I think they're interesting ones to discuss. What about the devil's advocate question, though, that we've had and I'm talking specifically for tech stocks, out of the .com boom came 90% of the companies that had .com after their name went bust. But
yes,
we're left with the Apple, Amazons, Microsoft. Would you just say that they're just completely overvalued beyond any means at the moment, or wouldn't the last 10 years suggest that they are in fact really good companies?
That's always the narrative that comes out, is that yes, these are very good companies, but what's the value of the future income streams from those companies? Is it worth what people are paying today? Are they paying too much for the future income stream of that? And you'd have to say, given the multiples that some of these companies are trading on, yes, they are. I remember a story about McDonald's when that first came to the market in the US in the early 1970s. I think my numbers will be, but the story's relevant. And they came out with their story, and it was a brilliant story. They were going to have so many McDonald's in the world, and it was a real estate play, as we know. It was more real estate, but they're going to have this cash flow from franchising. Well, the underlying business was sound. It had sound, as we know. It's been hugely successful, but the share price of McDonald's went ballistic. It overvalued the value of that what that business was really worth, but people just got caught up with the momentum and extrapolating into the future. And don't quote me, but I think it took something like 15 or 20 years for the McDonald's share price to get back to that initial euphoric peak, for the business model, for the business to actually justify that value based on future cash flows. So there's moments in market history where things just get carried away, and humans being humans, we tend to follow the herd. So what has been popular will continue being popular. So there's this whole drift towards what has gone up, because people think there's safety in something that's risen in value. Rather than something when there's actually, depending on the thing, but there's probably better value and more safety in something that's actually falling in value. It's cheaper, therefore it's got less to fall. That's a broad concept.
But you didn't see that value there back in March 2020, did you?
No, I didn't.
Yeah.
No, I thought that was the beginning of this corrective process that we'd seen, like after 1929 and other downturns that I'd been through, that I'd personally been through.
Yeah.
I thought, like in 2008, 2009, that there was this thing. The turnaround caught me completely by surprise. I didn't anticipate it. The extent of the Fed's efforts to say, hey, this is a support that we'll provide. And then that complete change in investment behavior, the speculative behavior, just went to another level, as we saw with the meme stocks and that sort of thing, and the Robin Hoods and all these sort of, and that thing just sort of captivated and just went. And so, yeah, I know I didn't see it.
Well, let's talk about captivating, because that brings us to code red number 2, which is you've done a lot of, you talk a lot about, you tell the other side of the crypto story. I know we have plenty of editors that are very bullish on crypto. I hold a little bit. I hold a little bit of gold. I'm kind of like, I've got my
fingers in
a lot of different things. But it'd be good to get, so what is it about that? I mean, you talked about the speculative fervor or the enthusiasm for markets when they're hot, and there's no hotter market right now than the cryptocurrency markets. But you specifically state in your report, Tether is something to be concerned about.
Yeah, well, Tether, and I'm going from Gary Gines, I think he's the SEC chairman, the newly appointed SEC chairman over there. So something like about 70 or 75% of Bitcoin pricing activity is filters through Tether, the stable coin. Well, I think it's beyond doubt now that Tether do not have the stable or the US dollar backing that they allege they have. The New York Attorney General came out and called them, said it was a lie and a fraud. I've read an academic paper that says, yes, the Tether was highly manipulative of the Bitcoin prices. It appears that they were, judging by the flow of dollars of the Bitcoin prices or crypto prices in 2017. They have what they call a letter of attestation issued by, I think it's a Cayman Islands auditor, that says, at 11:59 p.m. on the 26th of October, we saw this there. But they don't tell you what was there at 11:58 or was there at 12. That's a letter of attestation. And I've spoken to you about that before through someone I know very, very closely who was involved with a letter of attestation for a major bank in the US. And prior to that auditor coming in, they were told to move X amount of subprime loans off the books of this bank to other banks, and then when the auditor left, to bring them back on. So I know from firsthand that letters of attestation aren't worth the paper they're printed on. And these ones don't even tell you that they're backed by US dollars. So my concern here, Woody, is having been through the unlisted property trust downturn, the mortgage trust, some of the other things that have happened, where what appears to be a liquid investment, because money's going in sort of balances out money's going out, so the inflows and outflows are not like a Ponzi scheme, going in and out. Okay, it can keep the appearance of liquidity. But once that money stops going in and there's people start knocking on the door, like they did in unlisted property trusts in the 1990s or mortgage funds after the GFC, and they say, hey, I want my money, then if it ain't there or they can't get that liquid money, then Tether, which is capitalized at $70 billion, is in trouble. So if that's the gateway or one of the primary gateways into the crypto trading market, and it may or may not be, I don't know the extent of it, then you have a very weak link. You have a weak link there. And and that's all you need. Because don't forget, in the GFC, all happened from about a pool of $300 billion of subprime mortgages. So and that wiped $11 trillion off US household net worth. You don't need a lot to an old thing. You only need a snowflake for an avalanche or a match for a bushfire. And that's my concern with the Tether, is that it's just not there. Then you actually get to the Bitcoin stuff itself. And I personally don't see any value there. And people say, don't be stupid. Look at it. It's gone from this back up to 62 grand. It's being regular. They got this ETF, blah, 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 blah. But that doesn't make it real. just because someone wants to pretend it's real doesn't mean I've got to pretend to think it's real. It's what is it? There's nothing there. And again, I'm not the only person saying that. You got people like Jeremy Grant, people who have been there, done that, been around. Jeremy Grant said, "No, it's worthless." John Hussman, who all these people have made serious money out of going contrarian. John Hussman says it's worthless. John Paulson says it's worthless. Charlie Munger says it's worthless. You had the guy who wrote Black Swan. What's his name? In the Talib. Yeah, he was a crypto advocate, and he just said, "No, it's just nothing there." And so you've then had Jamie Dimon just come out recently and restate that that's there. So you got some pretty serious, financial experts who collectively are worth millions of dollars from making astute investments going, mate, ain't nothing there. So what is there? I think what's there is a belief in a concept, but does it have any actual material value? What's its asset? What's its cash flow? What's there? I can't see it. And to me, it's just the emperor has no clothes type scenario. But while there's this collective belief in that, that's what's driving it up. Well, this is going to happen, so they just keep pushing it up. And I just don't see that there's any value. And no one's actually told me or can show me where the value is. Where yes, there may be some adoptive by central banks of a Bitcoin or the whatever it is. What's that platform underneath it? The blockchain.
Blockchain, yeah.
Forgive me. I think I'm getting Alzheimer's, mate. Blockchain technology, that this may be adapted, but from what I've read, it's clunky. It can't handle the process, a lot of volume coming through. And as Ray Dalio said, who knows? There may be a bunch of smarter guys out there that, when all this is over and done with, may invent a better version of this stuff, so that may be used, because it is only, unlike gold, which is just gold. People say, "Oh, it's gold." Well, no, this is just computer code. And at last count, what was it, 10,000 of these sort of things out there? So there may be one or two that, maybe something that comes from the ashes of this. There'll be a crypto phoenix, I'm sure. But yeah, at this stage, I just think it's just part of this speculative fervor, in my opinion.
One of the things we're going to do, and I think we raised it in an editorial meeting, was it this previous week? I think we're going to get you on and have a proper structured debate with one of our bullish editors on. I think that'll be a fascinating discussion to break it down. Perhaps I'll moderate it, or perhaps Greg Canavan will moderate it. But I think that we're going to come back to that space. But in terms of this discussion, you see it as a classic fervid bubble, just like the tech stocks, and they're kind of linked in a way. In terms of the everything bubble that we see happening right now.
Yeah, it's a manifestation of the era we're in. And also, and this isn't to offend the millennials, because I've got daughters who are millennials. I see that.
Do they buy crypto, by the way?
Sorry, no.
No.
Sorry, no. I think my younger daughter in Sydney, she might have some, or her fiance's got some. We do have chats, but it's tiny. But I think it's just a rite of passage. Every generation, like we had the entrepreneurial stocks, tech stocks, the boomers. We've had our times of getting excited about something that this is we're the generation that's going to change the world, or we have this we know better than the one that went before us. So it's just, to me, that's part of this as well, and they get caught up with it. They bought into the narrative. But I think it's just a manifestation of the environment we're in, where speculation has led to accumulation at this stage. But as I've just finished tomorrow's Rum Rebellion, I said, well, it's not really real until it's in the bank. I remember giving client portfolio statements, prior to the tech boom and busting, and what their value was, in 1999 was different to the value they had in 2000. So unless it's in the bank, it's all just on paper.
Well, that kind of brings us nicely to the third code red, which is the bond market. So you say cashing out of crypto into other fiat currency, but essentially that's just being created via the bond market, right?
Well, yeah, the bond market is a mechanism where people go, corporates or governments go to borrow money. So there's this money out there, and they go, well, hey, we will offer you a rate of return for, depending on the duration, they can range from 30 days to 30 years. I think in Austria they did one for 100 years. It was some crazy duration on those sorts of things. So the bond market is where pension funds and large institutions tend to go to take a fixed interest exposure. But what most people, or what a lot of people struggle with the concept with bond markets, is that there's an inverse relationship between interest rates and capital growth. So as interest rates are falling, the value of a bond is actually rising, because if last year, for argument's sake, you could buy a 10-year bond, Woody, and it was paying 5%, then you've still got 9 years to run at 5%. Whereas if this year that bond is a 10-year bond's only paying 2%, so you're going to get 2%, then your bond in the market, if you want to trade it, is worth much more, because there's 3% per annum for the next 9 years above what the current one's trading at. So so you've had this bull market in bonds that has been unbelievable. It's been going for 40 years. But you've got that next layer in the bond market, the corporate bond market, and we get down to the sort of less than investment grade stuff that's B plus or B minus anyway. The compression in the yield there, that's the difference between what you can get from a US government bond, which is considered risk-free, because the US government is never going to default on a bond. They can just print money to cover it. So, but if you go and lend a corporate, like a triple C corporate, like Evergrande, who went to the US market to borrow money, then there's a risk that they may or may not live to see, survive commercially to meet their obligations. But what we're seeing in that market, there's only about a 3% differential between, what the risk-free is and what these higher risk or junk bonds are paying. It's just compressed down because people just keep stepping further and further out in the risk curve. The last time the margin between the risk-free and the riskiest type investments was at this level was, guess when? Late 2007.
So we say 2008.
Yeah, it was the same sort of level of compression, because people just kept stepping out further and saying, "Well, geez, I'll get 4% from Evergrande, whereas the US government's only going to pay me 1%. Bugger that. I'll go out there. This is a Chinese developer. Blah 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 blah." Well, as we see, they're defaulting or not making their interest payments, and Evergrande's just one example, and that's one of the reasons why, against their charter, the Fed in March last year stepped in and started buying high yield bonds or ETFs, because they know the sewerage that exists in that market is they're just toxic. But so that would just create this contagion effect as they started to default. So they came in and provided a level of support there. But they're still zombies. They're still sucking blood out of the economy, which is why, and I wrote about this earlier this week, I showed the Atlanta GDP now data. 3 months ago, they sort of do a forward forecast of what they think that the GDP is going to be for the quarter. They were predicting, they were estimating GDP growth would be something like 6%. You know what it's down to now? Their forecast for this quarter, 0.6. In the space, it's just gone like that. In the last 2 or 3 months, the outlook for the US economy has just tanked as far as growth goes. And the reason being is, I think there's the sapping in the energy prices, which we're yet to see flow through to corporate earnings. But underneath it all, you've got just such dead wood in the US economy that's just sucking the life out of things, and it just can't get traction. So yes, I was surprised last year in March because you had this spike, and it was just really an adrenaline shot to an otherwise, very, very sick body. And it's given it, and it's all perky, but now that's starting to wear off. Where we've got the patient back. I think we're going to get the patient back in bed, and I'm not sure the next adrenaline hit is going to be enough to stop it from some sort of collapse.
Well, the fourth code red you talk about is coming from China. Now you mentioned Evergrande. Sounds like that's like I say, the four code reds are kind of your way to navigate this huge bubble that you see in everything. So it's kind of, but as you talk, they're kind of all connected. You start with tech stocks, and then it brings you to crypto very easily. Then obviously the bond market, which is kind of at odds with the crypto thing anyway. But then the bond market, there's links there with Evergrande too. I mean, it's all interconnected, and I guess that's your point, isn't it?
That's the whole financial system, is that it's all interconnected, and I'll go again another little bit of history, and we know this from Jim Rickard's association is with long-term capital management. The hedge fund that was developed in the 1990s by these Nobel Prize-winning mathematicians. Had all these and it was highly leveraged, and investment banks were in there, blah blah blah, and they had an exposure to US government bonds, Russian government bonds, and it was basically the Russian government gave them the bird, said, not going to pay that. Well, that shockwave, thousands of kilometres away, sent ructions through Wall Street, and that was when the Fed got together and did its first bailout, and in people who are old enough to remember the old Bankers Trust, BT, was big in the 1980s. It's where Keir Nelson of Platinum started his career and that sort of thing. Well, BT was a casualty of all that. It had to be sold off, and that's why that brand no longer exists. So the interconnectivity in markets is well established. Something can go off in a part of the world that reverberates right back through to somewhere else. And so the Chinese issue is that the fact is that they have adopted the Western growth model, but with steroids. I thought we were bad. Mate, the known and unknown debts in that country are just, in the banking sector, in the shadow banking sector by local governments, it's just mind-blowing as a percentage of GDP. So you can't tell me it's all been used for productively, and there's been no malinvestment with that, as we're seeing with Evergrande. So how do they get down from there? Do they then say, you know what? We're just going to let some of this fall. We've got to take a stand on what is it, moral hazard, and say, we can't just underwrite every company and we'll come to bail them out and they can go on doing this. I think Xi Jinping is sort of, he tends to make examples of people or things, and like, no, you're guilty, hang him, get rid of him. So I get a feeling that China may, just say, listen, we've gone beyond where we need to be, and we've just got to rein things in. So even if China reins it in, as we're seeing, their GDP numbers are coming down to 2-3% now. They're no longer in the 6s, 7s, 8s, 10s, and their relationship with the world has changed. It's more adversarial, and
especially with Australia. I mean,
yes, yeah. So, and again, this is nothing more than fanciful thinking from me while I take a run on the beach. These thought bubbles I have is, what better way to have a crack at? Why start a war with the West? Why not just collapse the financial position or give them a lot of financial pain to worry about? So could he be shooting himself in the foot, but that we get bullet holes? We get more bullet holes, I don't know.
Well, this is something Greg's been looking into for years, and I remember we did a big report in 2012, and the crux of that report was that what China really cares about is its social stability as opposed to the profits, especially the profits of Western credit debtors. Corporate.
It couldn't. So that's the popular thinking, is that Evergrande will just tell its foreign debtors just to go go whistle in the wind, guys. You ain't getting that cent from us. So that may be the case. But they do tend to play a long game. You know, I'm no expert on China, but, you know, they do tend to play a long game, have a very long horizon compared to the Western world. So, yeah, they may decide to inflict some pain. Who knows? I don't know. I wouldn't discount it. I'm not saying that they say, yep, we're happy to take a couple of shots ourselves, but it'll hurt you guys more than it'll hurt us.
So that's a good navigation of this extensive report that you published this week, Vern, and it's the key topic that makes up an invitation to the Gowdie letter as well that we just released. But obviously there's some solutions involved as well. But what do you say to, what are people meant to do then? I mean, you don't want to give your whole game plan away because that's for subscribers. But
it is not easy because when you say, listen, I think you should be cashed up, cash, and the mind game or the word association game. When I say cash, people think trash, or nothing. Or, oh, that's dead money. So the word association game at present is all in the negative when you say cash or term deposits.
It's kind of how I started this conversation, right?
Yeah.
The big worry in people's mind is inflation at the moment. And what you see with key individuals, like guys like, the CEO of Twitter, Jack Dorsey, coming out saying, it's easy to see that we're on the road to some kind of huge inflation, whether that be hyperinflation, but in addition, sorry, I interrupted.
No. Yeah, I understand that. I just cannot see hyperinflation because hyperinflation would give you double-digit interest rates or triple-digit interest rate, or whatever, very high interest rate, and things will crack long before then. You raise if the banks all come out and say, listen, we're going to raise mortgage rates by 2% here in Australia. My godfather. No, you would think people had their hand in a vice and was being cranked. The pain, the screaming would be unbelievable because, it would just be, so you don't have to go far. So getting interest rates to a certain point, you won't get hyperinflation because once they get there, you'll have this massive defaults. You'll have this economic activity will fall down and you'll be back into a depression. So I just don't see hyperinflation coming through. If it is, it'll be a temporary thing because you have to have an interest rate response at some point to that, and that would just crush things. So those things tend to happen when you've got very low debt to GDP type thing, not like we're at now. So yes, I can see the inflationary trend, that people are seeing that, but we're not getting that yet in the velocity of money in the US. It's still low, so that it hasn't got out yet. So people are either absorbing that, either the businesses are absorbing that cost, or households are just saying, you know what, we're not going to drive as far, or so the prices have gone up, but then people's unless they've had wages increase, they can't spend any more. So therefore, I don't see inflation at this stage, unless you get wages growth pushing through, and that may come, but others like Lacey Hunter are saying no, who invests only in US government bonds, either short or long dated, saying no, there's just too much debt in the world, and people have got their obligation to service that debt both on a principal and interest basis is just taking away their disposable spending capacity. So therefore, that's going to create it. So yeah, the deflation ranges are deflation, low inflation, stagflation, high inflation. So where did we get to on that?
When people's face, when you say you
so talk about cash. So therefore they think, there's inflation coming, I'm going to get an erosion of value, blah, 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 blah. Understand that. I understand that. But by the same, so as I said, the word association at present is cash, trash, nothing there. Have a market downturn, and the word association is cash. Oh, I need it. I love it. That's cash is king. The whole narrative changes depending on people's mood, or where they perceive, markets are at. So while they think it's in a buoyant and risk-free stage, then cash is the porker. But when it turns, and the thing is that what people forget is that when markets do turn down, then assets, the buying power of cash goes up, because let's say the Commonwealth Bank at $100 a share goes down to 50, or let's say $40. Let's say there's a 60% correction. So you get 40. You can now buy 2.5 times Commonwealth Bank shares for your $100 in the bank, whereas prior to that you only could buy one. So your actual buying power of your cash has been increased by 150% in that environment. So it's a very narrow view of buying power that's used, because market corrections provide the capacity to significantly increase the buying power of cash, which is what it's there for. So I understand why the prospect of saying go to cash, people would just go, oh, mate, is that it? That's the best you got? Because everyone's looking for this magic cure. Oh, there's got to be somewhere else. There's this other magical pot you can go to where it'll give me my 5% and no risk. Well, yeah, I've got a bridge to sell you in Sydney as well. It doesn't exist. It's there's only so many mainstream asset pots you can put your money into. So my advice is, if you are of a mind to think, yes, this market is at an extended valuation level. Yes, the Fed has, we know the Fed has pumped it up, but I have concerns about whether they can continue doing that, or have we reached a point where, there's a probability of markets correcting, and maybe the Fed can't rescue it like they did last time. Then what you do is you go, okay, how much do I keep in markets that, in the event they fall, and bear in mind that, we could have market ups of between 50 and 70%. So if you want to work worst case, if the market was to fall, say, 60 to 70%, then I will not break out in too much of a sweat. So therefore, if you've got, say, I'll pick $1 million, and you put $500,000 of that into market-related stuff, and it falls by 60%, can you handle a 300%? So can you handle your $1 million going to 700?
Mm-hmm.
If that causes you, geez, that might change the world trip, or the caravan upgrade, or this sort of thing, then you dial it back to a level where you feel that, okay, so if I dial it back to, say, 300,000, the market goes down 60%, I'll lose 100, I'll be down 180. Well, that'll give me 820. Okay, I can still live with that. So you've got to find a level, because the only thing you can do is manage risk. You can't avoid it. You can only manage risk. There's a risk in everything. So where markets are at this elevated level, then you've got to try and manage that downside risk. Don't worry about the upside. Because unless, and I've said this before, unless you genuinely believe that markets are now in a linear progression, albeit with a little bump, ever upwards, and that the word market cycle has now been taken out of the vocabulary of financial vocabulary. So cycles will never exist. They'll never rotate from up to down again. Then unless you truly believe that, stay 100% invested. But if you are concerned that you've built a sufficient pool of capital that you're somewhat relying on to achieve your financial goals, be it retirement or whatever, then you've got to find a level that you feel comfortable with absorbing a certain amount of loss, so that you won't be panicked. And
that's good advice.
You know what fear does?
Well,
it robs you of the capacity to think rationally. When people are fearful, you saw with that's what terrorists work in. That bomb in Spain, they set off a bomb over here, and so people just automatically ran in that direction because it was just a primal response, and they set off a bomb over there. It was just cruel, but they understood the primal responses of people. So panic and fear robs you of the capacity to think rationally. The time you need to think rationally is before this happens. before it comes, unless of course you don't believe it's coming. And I just don't. I just find that inconceivable based on all the history we have on markets going back to the tulips in 1620. It's just inconceivable to think that markets don't rotate through a valuation methodology from under to over.
Well, thanks. I mean, there you go. I mean, this is why I kind of love this business, because we have lots of different people thinking about lots of different markets and different strategies, and by having those different opinions, and it makes you think harder, and it forces you to think more rationally, even if you're completely on one side of the spectrum. It's always good to see the other side, and that's really
and I've said this to you before, Woody. I think what's been indelibly printed in my mind was that storm financial experience back in 2007, when people in their 60s and 70s, people who had retired, had built wealth, built their retirement capital, had owned a house, went into a strategy where they had discounted risk, and the risk was so obvious. You've got $1 million of your money and $1 million of debt. You've got $2 million. Well, all you need is a 50% correction, and there goes your equity. Because the remaining $1 million is the banks. It was a simple mathematical risk model, but they discount, and I saw people just lose it. People lost homes, they lost everything. It was just, and some people committed suicide because it was just the market, I think, that tends to gravitate towards me, or where I get pigeonholed, is probably in that boomer retiree type market. The wealth accumulators, which is the beauty of fat tail research, is that they can take that little bit of risk with that money if they're in their 30s and 40s. But once you start moving to a certain phase in your life where this capital is important, or is to serve a particular function for me, then you've got to kind of think differently. Because when you're 35 and you've got a 50 grand and it goes down to 25 grand, you lose half the dough, or it goes to 20 grand. 30 grand is not a lot to make up. But if you've got 500,000, it goes to 200,000, same percentage fall, but boy, it can just change people's lives.
Well, there we go, everybody. The everything bubble cash out strategy: how to smartly exit code red investments now. That's your latest report, Vern, and it's available now for everyone to read. Thanks for making yourself available to talk it through with us. Much appreciated.
No, my pleasure. Thanks for giving me the time and running over time.
No, it's good. There's no time frame, but I'm sure the one thing about that we do publish is contrarians. And if you're a contrarian, you have to. It's like that Michael Burry that you quote him quite a bit, but he was willing to stand his ground for those. I think he first shorted. He created the credit default swap, and he first created that in 2005, I think. And it paid off very handsomely in 2007, didn't it? So.
Yeah. By the time, 2008, really, because by the time the investment banks stopped fudging things behind the scenes and actually let mark to market without trying to pass on all the toxic stuff. Yes, he finally had his payday, but it was a delayed gratification, and it is. It's in this world of instantaneous stuff, or give me the hot thing, or give me that, going up. To hold your ground, and I don't do it belligerently or out of I'm not going to move. I've stuck this peg in the ground. I'm standing here, because when it's all said and done, Woody, I'm it's self-interest is what I'm about, and I'm trying to do this for my family as well, because I don't want to have the buying power of our capital, which was the fruits of a lot of hard work and taking risks. I don't want to see that deteriorate with the buying power of that deteriorate. But by the same token, I don't want to, take too much of a risk with it that again, the buying power of it deteriorates because I've just lost so much capital. Part of this is cathartic for me somewhat, in that I get to this is how I'm thinking. This is what I'm seeing. This is the maths behind. This is the logic, and it's really hard staying anchored in that when you're in an emotional type
state. Yeah.
Investing or social mood. Where you go out and everyone talks about this or that sort of thing, and you just retreat back because.
That's when you trip back, go for a walk on the beach.
Yeah. Who wants to listen to the man holding a sickle and the hooded hat?
Well, I always like listening to you, Vern, and talking to you, and your perspective is hard one and really worth listening to. So thank you for your time. Much appreciated.
Okay, thanks, Woody. Cheers, mate.
Take care.